Okay. I think the numbers have stabilized, the attendance numbers, I think, is in the participant numbers. So I think we can probably get started. I'll just set up the chats again. All right. Okay, so what today's about, so it's a 2-hour session. So 11 to 1 my time, 9 to 11 your time. And it's for all intents and purposes, I should just make that up. For those that just came in, just remember to just please mute your microphone. Okay, I'll just put that through again. Thanks. Okay, so it's the exam revision. So as you know, or should know by now, there's a list of topics and it's going, okay. Yeah, I'll get to that shortly. So as I said, it's a theory, given that some financial institutions and monetary theory. The exam is a theory exam. So what we're going to do is go through some of the main concepts that will be tested on. Okay, so I've just had a query. I'll address it now. So I just had a query saying, when will the results of the group assignment be published? Okay. I was in, from your local teacher, I was in receipts, as in I received the markings just yesterday. So what normally happens from there, okay, so what normally happens from there is I then look at the markings from your teacher, okay, and we call it moderation. So then I will go through those. So I would expect within the next, say, 2 days, maybe in the next 2 days, the results should be released on Collaborate, okay? So they're now with me, so I received them yesterday. It'll take me a couple of days to go through them just to make sure the marking's okay. I'm sure it is, but I just have to mark it. We call it moderation. And then I'll say again, okay. And I'll suggest within 2 days. So hopefully no later than Friday, because I do want you to know your actual scores, as in before you do the exam, so you know where you are. Okay, all right. I'll try to, because I am seeing questions come through. So one is about suggested word limits for 2 parts of the final exam. Okay. At the very end of this presentation, I am going to give you a sample answer. Okay, so at the very end of the presentation. So I'm going to talk about the topics, what they are, and we'll have slides in that. But at the end, I'll give you a previous exam question. Okay, so let me before I do that. Yep, not a problem. Just let me say what the test is about, the exam is about, and then I'll get back to your point. So it's a 2-hour exam. So section 1 has five key terms. So it might be something like, briefly describe Keynes' transaction motive. So the very specific one, or briefly describe denomination divisibility. So at this stage, just let me put this through the chat, because we are going to go through the concepts, so don't worry. This is the way I would approach an exam, okay? So if you look at it, there's 120 minutes, 2 hours, yes? And really, if you look at it, there's one section that has 10 marks. Then there's section 2 where there's 4 questions, open-ended, that also have 10 marks each. So the way I'll basically just dividing my time, I know all of you know this already. That's just simple approach. Okay. So given that you have 10 marks in section 1, then you've got 10 marks to come 4 times in section 4. Go 120 divided by 5. So spend roughly 20 to 24 minutes on each question, about 20 minutes each. Again, at the end of this session, We're going to go through a question together, and we're also going to go through how you should answer a question, like what you should use even in the opening sentence, how you should do it, examples within, etc. So we'll go through an example at the end of this session regarding an open-ended question. I will then put these slides up on Collaborate, so you also have that example with you, okay? And that will give you a rough indication as to how many words are needed. But just from a time perspective, how much time? Aim, rule of thumb, aim for about 20 minutes for section 1, and then 20 minutes for each of the 4 questions. And then you have a bit of time around that. There was another query, I just have to go up in the chats. There was another query that came up. Okay. You would have seen, and this is what we're going to also go through today, and this is why we're going to be a bit more specific. You would have seen in your last lecture that I put up a list of topics there, and this is what we're also going to go through today, but in briefer form. Okay, so the topics are on the next page. So I assume you're referring to this, where I received the message, okay? And the comment I've received from the student is, will knowledge points outside of this be tested on the exam? So this is the topics I've given. So is there anything outside of this that will be on your exam? So the answer is no, okay? As in, your exam will come from these areas, okay? However, what I say to all students though, so that's, I hope, answers your question there. But not everything here will be in your exam, okay? So I hope that makes sense. So everything from your exam will come from these topics, but does not mean that every single thing here will be on your exam, okay? So in other words, regulation, so I'm just giving, don't take this, verbatim, don't take this too literally. I'm just pointing out an example as a hypothetical example. Just because regulation is in these topics, it does not necessarily mean it'll be in the exam, but it's something you still need to study. But in your exam, nothing outside of here, okay? I'm not trying to trick any of you, okay? Your exam content will come from within these topics. Okay. All right. Cool. I think that's similar to what I've just already answered, so that's okay. All right, so basically, as I said, at the end of today's session, I'm going to give you some tips on how to answer the question. And as I said, and then we'll go through a question together. And it's going to be an open-ended question, okay? An open-ended question. And that's going to be the way I've answered it in today's lesson should be in your heads. You should be thinking to answer that in a similar way when it comes to your questions in the exam. Okay, so even like, as I said, how we approach the first line, what examples do we put in, how do we explain it? And that will give you, as I said, an estimation of how many words you should put in your response. But the best thing is don't try to count the words. I mean, normally you should just write directly on the topic, and as soon as you feel that answers the question, then that normally is sufficient. Because a tip I'm going to give you at the end of the class, but I'll mention it now here, I'll mention again at the end of the class, one of the worst things to do is just to write because you think you need to write. Okay, if the writing is not related directly to the topic, you're going to lose marks. So don't worry about that now, Zen. We're going to speak about that at the end. Yes, it's exactly what, because only I can see that. So I'll say it again to everyone, okay? I'll say that again. But yes, the answer is yes to your question, but I'll say this to everyone. So again, I got another question about the exam questions. Okay, again, just to be clear, the final exam questions, okay, all come from these potential areas. Yes, that is true. What's on our slide. And yes, no other content outside these potential areas will be on your exam. Yep. Okay. I'm hoping that answers your query, and I'm hoping that answers everyone else. So it's what we are seeing now on this slide. Okay. So what we're seeing now on this slide. So in other words, your 5 short answers, remember we said before in section 1? So your 5 key terms that need a small definition, say 3-4 lines definition, will come from here. And these 4 open-ended questions, which is where you write maybe, 3/4 of a page or 1 page, roughly. will also come from this here. Okay, so it's very clear. Again, I'm not trying to trick any of you. It will all come from within here, okay? Okay, excellent. All right, so as I said, what we'll do, because it's a theory topic, we're just going to have a bit of a chat and we're going to go, yep, okay, good. No, that's fine. I'm hoping everyone gets that because a few people sent me comments regarding that. So good, that's good. I'm glad you guys understand that. So it's all from here. So what we're going to do now is just go through these topics, okay? So we'll spend a bit of time on that. And then I said at the very end, what we're going to do is go through how you answer exam questions, which I'm pretty sure is what you really want to know, but we'll save that to the end, okay? How do you answer an exam question? And then we go through an example of that, okay? All right. All right, so we'll start off with, again, this is more just going to be talking because we've done this in class once. As in, I taught you early in the year about this. We also did a review for your mid-semester test, which was on this. And I also know your local lecturer would have recently done this. So I'm not going to go into too much details here. So I'm more just going to perhaps ask you guys questions, and I'll just see how your response is, as if people know this or not. Okay. So one of the topics there was regarding direct and indirect finance. So what do we really need to know, as in really need to know for an exam situation? Okay. Well, we need to know that direct finance has, as it says on the slide there, just two parties. And we know those two parties are the SSU and DSU. So I know it's been a while, so I want you to tell me, okay, just one word answer, that's all. Excuse me. Of those two parties, which of the parties needs the money? Which one? So which one needs the money? Okay, excellent. So again, see, everyone knows, that's good. So we all know it's the DSU. So all I want to then say is this. So another thing that we must know is, what do they do with the financial claim? What are they doing with the financial claim? Remember what a financial claim is. As you're thinking about that, remember the financial claim is, it's a contract. Excellent. Okay, so it's a contract regarding the amount of money, principal, and the date. Okay, so I've got one, so that's good enough for me. So what they do, but I'll type it for everyone, that answer. So what the DSU does, which the financial claim, is this. Again, we all should know this. Okay, they issue the financial claim. They're issuing the financial claim. So that's an important part to know. So then we know that obviously the other party, the SSU, which we should know by now is the surplus saving unit. What do? Well, they provide the money. So they buy the financial claim, okay? And then the only other thing I might want to add is these words, and then you're going to tell me what they mean, okay? And then this will be enough to know, okay? I'm letting you know that this will be enough to know. So I'm just typing in the words now. And tell me, who does it belong to? So there's something called interest-bearing liability and interest-bearing asset. So IBL and IBA, and who has what? So for the SSU, it's a what, and for the DSU, it's a what. Okay, excellent. Okay. Excellent. I'll just give that message to everyone. So that's all we need to know. So what we've written here, or what I received, sorry, is this. Okay, so everyone then can see it. And that's all we need to know for this area. Okay? All right. Indirect, now instead of two parties, there's three parties. And we just said that the third party is an intermediary, which we can call a financial institution or a bank. So there's a third party involved. Okay? So as you can see at the bottom of that slide, one of the most important things is regarding two different contracts. Okay, so two different contracts. And then what I'm going to ask is the following, okay? So I'm just going to put something through the chats. So it's two different contracts. One is the SSU, so the surplus saving unit, and the financial institution or financial intermediary. And the other one is the DSU, the deficit spending unit, and the FI. So again, so what do you really need to know? Okay, so if the DSU, okay, the deficit spending unit, if for whatever reason they cannot pay back the loan, so they default, what is the impact on the SSU? Okay, I'll repeat that. So if the DSU defaults, so can't pay back the loan to the bank or the financial intermediary, yep, that's right. So what is the impact of the SSU? There is no impact, okay? All right, good. So DSU defaults, yep, that's exactly right, yep. So no impact on SSU, but the bank, we'll call it, okay. Oh, I should send that to everyone. And that goes back to the two separate contracts, okay? The two separate contracts. That's the reason. Okay. So now we're talking about financial or the benefits of financial intermediation. Okay, so this might possibly come up because, it's going to be maybe a bit difficult for this to be a long-ended, that open-ended question. So I'm thinking, if this is on the exam, this might maybe be one of those short answer type questions in section 1. So what is asset transformation? Well, I know we can all see that, but what are we transforming? And it says they're liabilities into assets, okay? So asset transformation. So and to be a bit more specific, well, I'll go back into the chat, sorry. Okay. Okay, so just being a bit more specific because it's still liabilities into assets, but if I maybe wanted something a bit higher in my explanation, okay, I'll say it's actually transforming short-term liabilities into long-term assets. And if I wanted maybe a bit more, I would say they do this because, let's see how many remember from our previous classes. Can anyone finish off that comment in my chat? So I'll just, as you're thinking about that, I'll just say it again. So asset transformation, we're transforming something into assets. What are we transforming? We're transforming liabilities. Then we go a bit more specific and say we're transforming short-term liabilities into long-term assets. So all I've asked now is why? Why do banks do this? Yep, okay. You're right, and then I've got an answer saying they connect savers and borrowers. Absolutely, because that's why they're the intermediaries. So they're connecting the savers and the borrowers. But what I really wrote there was they're trying to take advantage of something. Okay. I might give the answer because I know we're short for time as well. And I do want to get to the end about the exam sample questions. Net interest, okay, we're starting to get there now because I got an answer called net interest difference. So I'll just write it out, okay? So they're trying to take advantage of you're right about the net interest difference, but I just want to put a bit more. All right. Okay. There might be some spelling mistakes in there, guys, but that's okay. All right. So really, again, I know I taught you a long time ago, but remember what the reason why they did this is what we say is take advantage of the normal yield curve. Because remember, the normal yield curve is low and increases over time. Okay. Interest rates are lower at that time. net interest difference, and that's correct. But this is just a bit more information regarding that. All right, so asset transformation, short-term liabilities into long-term assets. Why? Take advantage of normal curve and maximize the interest difference to the banks. Denomination divisibility. Okay, so you can see there pool savings of many small SSUs into larger investments. Okay, so raise. Oh, now I'm using a word, again, so I'm just putting these through the chats, guys. So raising small amounts, excellent, thank you. So I just got that as well. Yep, small investments into big investments. And as you know, that why again is to give lending to people who need big amounts of money. So I just called them bigger customers. What I mean by bigger customers is those that want big amounts of money, large amounts of money. And then the last one, so thanks for that, Mikhail. So the last one, currency transformation. I'm just going to go straight to the why. Okay, so currency transformation. So what is it? Again, you're transforming. Guys, just with the microphone, if you can, just remember to mute your microphone. So with the currency transformation, we're transforming a currency from one, like say Australian dollars to Chinese dollars or American dollars or euro. I'm just putting through the why, which we should all know. It helps with foreign trade, okay? It helps with foreign trade. So there could be a possible like short type answers, like you'd only get one of them. You wouldn't get all three. You wouldn't say explain asset transformation, denomination, and currency. If it's on, you'd only get one and say explain one of these. Okay. All right. So you would have seen, in the list of topics, there was Keynes and Friedman. So with Keynes, see how I've made it now a bit more specific for you, okay? See how I'm now just focusing on two things, role of income, role of interest rates. So again, if this was a question, this is what you would have to do. Whoa, I'm gonna go back into the chats. Okay. So I'm going back into the chats. Now, so I'm just putting this through now. So if this was a question, you need to explain what impact income and interest rates have on the theory. But let me explain a bit. If you get a question, I know that it wasn't regarding Keynes, okay? You wouldn't get it just on Keynes. What I mean by this, let me explain it better. You would not get a question that says, explain Keynes regarding income and interest. It wouldn't be that. It'll be something like this. If you look at the slide, it'll be, explain it regarding the transaction motive. Or another question might be the precaution motive or the speculative. It'll only give you one motive, okay, if it's on the exam. It will not tell you to explain all three motives or even two of them. It will be very specific and it will only mention one motive, okay? So again, my question now to you, so I'm hoping to get some answers on the chat, okay? What is the role? And this is an important thing to understand because every year, every semester, it seems students get this confused. So I want to start with this. What is the role of interest rates, okay, on transaction motive Keynes? What is the role? And when I say the role, okay, just to be, we're talking about its impact on money holdings. Because remember, the theory is about money demand, holding money. So in the transaction motive, if we can remember, if you don't remember, that's fine, because you probably haven't started studying. But maybe there's one person that might know. If no, of course, I will give you the response. Okay. That's the, someone's written store of wealth. That was the function of money. And the store of wealth refer to speculative motive, not transaction motive, but that's okay. Good try. Good try. I might give you the answer because I know you probably haven't studied yet because you have other exams. So I'll probably start off, okay? And the reason I said interest rates is the following. So interest rates, if we can remember, has okay, so look at what I'm going to type through now. So this is really the reason why I want to be focusing on this. So look at the slide and go, what is the role of income and interest rates on? And then we said, let's focus on this motive. And look at the answer I just gave in the chats. Interest rates, no impact on transaction. So now I will tell you what has been a problem with previous answers, okay? Okay, this has been a problem with previous answers. It's the following. Because interest rates has no impact, some students don't even mention it at all, okay, because it has no impact. So they don't even write it at all in the sentence, okay? That obviously loses half the mark for that question. When I say half the mark, if it's out of 10, you'll lose 5 marks, okay? Because you haven't answered one of the categories. Or, okay, some students do this. They write what I write on the comment. They say interest rates has no impact on transaction motive. And then they just stop there. What is missing is this. And I'm not shouting, but you need to explain why. Exactly. Thank you, Nicole. It happens every semester and it happens with a lot of students. They either they think, oh, no impact, so I don't have to write it. Or as I said, they say, it's no impact, so I'll just write no impact, but I don't have to explain it. Now, you still have to provide the reason why it has no impact. Okay? You need to provide the reason. Explain why. It happens with, I don't know, I'll say at least 20, 30% of students minimum. And that's, a lot of marks you're just throwing away then. Okay, so you'd explain why. So then what you might do is then go to the function of money and say, okay, transaction motive, the function of money, medium of exchange. Okay. And we know that because it's not, and what was the reason for money? It's only to make transactions. So there's no wealth element, okay? There's nothing about wealth or store of value, store of wealth. So because transaction mode, I'll write this down briefly, okay? Because I don't want to go through everything. So because transaction motive does not acknowledge, and your answer will be better than mine, by the way, because I'm trying to do this as brief as possible. Okay, you'll do it a bit better than this, but in essence, these are the key things. When the person who's marking your exam, they're looking for key things, and we're going to go through this at the end. So they're looking for key parts, okay? So they'll be looking for something in an answer. They'll be looking for something which says store of value, and they'll be looking for something that says maybe medium of exchange, or they're looking for something that says money holdings. The other thing I should mention is this in your answers, okay? It's good to state the direction of the, again, these are all things you should know, but this is what I mean. So I'm not, can we see that? So good to state the direction of the relationship as well. So if we're talking again about the role of income in transaction motive, we say, yes, it does have a role because you need income to spend, and transaction is about spending money. It's the medium of exchange. And then we then say about the direction of the role, okay? Positive, negative, etc. Okay. So now what I'm going to do is very briefly And you should everyone should know this. At least, okay, let me rephrase that. You should all know this by May 30, sorry. All right, so I'm just giving you what each one has. So transaction motive, you should know. When I say income but no interest rates, there is a role for income. There's no role for interest rates. Same as precautionary, there is a role for income, not for interest rates. And speculative, there is a role for both income and interest rates. But remember, this is an exam revision. So what do you need to think about? You need to explain why this is the case. Okay. So the speculative motive, you would say why? Because of the store of value. You can use money to build wealth, and wealth has two competing assets, money and bonds. Since bonds have interest rates, as in their interest-bearing assets, interest rates now become important in money demand. So I would say for SM, you would need to mention, well, building wealth, store of value, bonds are also wealth and have interest rates. Okay. Okay, this is how you need to approach. So I've just put it through again in the chat. So speculative motive, you need to say, okay, you need to mention something about building wealth because that's the speculation about the store of value. So again, remember my typing isn't great because I'm trying to be a bit quick. That bonds are also wealth and have interest rates, then the direction. And that only explains the interest rates part. Then you'll have to also do the income part. Okay, but that's how you need to be thinking when you're addressing those questions. All right, what about freedom? Can someone, sorry, Friedman, can someone just in the chats briefly talk about the role of both income and interest rates? And if not, I will put it up, don't worry. Again, because I don't really want to go through too comprehensively, which is more just what you need to know for exams. So in other words, is income important and are interest rates important? Is basically all I'm asking for Friedman at this stage, that's all. And that formula probably gives it away. See the formula here? Probably obviously gives it away. So we say income so that should be obvious that income has a big role, even though, and you remember, we need to be specific in the exam. It's about the permanent income. But what about interest rates? I've deliberately not put it in the chat so far. What did he say about interest rates? I'll give you the option. There's only two options. Okay. That's exactly what I was, because I wanted to go a bit further. Thank you. Your answers have actually, yep, excellent. Because I was going to say, not only is there a role, which there is, okay, but as the students have, a few students have mentioned, and this is the important part, so by just saying, if your answer, this is my point, if your answer says, and interest rates also have a role in Friedman, okay, you get part of it right, but you don't get a very good mark. Because Friedman's very specific that the role, as other students have mentioned here, it's a small role, has little effect, we said, little. And then again, of course, you then have to explain why there's little effect, okay? And we went through this in twice. We went through this in one of the lectures and also when we did our mid-semester test revision. Excellent. And that's exactly what I'm going to put up now. I'm just going to add one more thing to it, okay? So you're right, the student that just messaged you, but I'm just going to add one more thing. Yep, opportunity cost. Excellent. Just also don't forget the competing asset groups as well. So competition amongst banks is the main answer. So that's correct. So you've done well. But also just try to remember the other asset groups as well. Remember there were four asset groups. Okay, the money, bonds, stocks, and physical goods. So also just mention the competing asset groups as well, but very good. Okay, so that's how you would approach these questions. So if something, again, just to sum up, because I'm already looking at the time, just because something does not have a role, if you're asked what is the role, you still have to say, well, there's no role, that's the role, but then explain why there is no role. Not answering it at all or just saying there's no role isn't enough. Okay. All right, the next topic were the two money creation ones, and it was exogenous and endogenous. All right, so exogenous, when we talk about exogenous money creation, okay, we're talking about it via this aspect here. So when I say this aspect, it's what I'm pointing to, which is the fractional reserve banking. Oh, let me go back in the chats. Okay, so fractional reserve banking for exogenous. And we know that both of them, okay, whether it's exogenous or endogenous, we know that both of them, banks need to make loans. Of course, we know that. All right. So if this question was to come up, again, for your exam, you'll need to provide a numerical example. So the example we've used 100 times is to say, money goes into one bank, $1,000, and then you choose whatever reserve ratio you want, required reserve, whether it's 10% or 20%. Obviously, if it's 20%, then 200 is reserves, then 800 gets lent out. And then you just have to go at least 2 steps there, then go to the second bank because that's important. Okay? So I'm just putting it through the chats. Go at least to 2 banks. You don't have to go to the third and fourth, but then say that $800 goes into the second bank. Then that has the 20% reserve, 160, and then the 640 gets lent out. Then provide the figures, money supply, money creation. Remember, the focus is money creation. What you'd also need to give me, because remember, he's talking about how money's created, is this. Again, something we've all gone through, which is what I'm putting through in the chats, the order of the money creation. So just very briefly, even with 3 letters or 3 words, just from one student will be enough. What is the order of money creation under exogenous? Oh, I can hear typing. No, almost. Almost. Again, just a reminder, guys. Yep, that's the one. Just remember, guys, if your microphone, can you please mute your microphone? That would be great. Don't have to go through all. I'll mute that. Okay, excellent. All right, yep, I'm starting to get that. Yep. There was one that did it the other way, but I'll put it through now. Yep. So remember, and it's very important, the order. So the deposit comes in first, and then remember, it is the Okay. So just remember that, okay? So it is not deposit, loan, reserves. It's deposit, then reserves, okay? Then a loan, because the reserves are considered first when money comes in the bank. Then it's about making the loan. And then you would have to say this, because this is how we start to structure the answer. Since reserves come before the loans, and that's why I just wanted to make sure you know the order. Since the reserves come before the loans, okay, who's in control of the reserves? Well, by now we should know that's the Reserve Bank, or I shouldn't say that, sorry, the central bank. So the central bank now is important in determining money creation because they can change the level of required reserves. And for a very good answer, I mean, this is a good answer, don't get me wrong, but maybe for an excellent answer, you might also want to mention, okay. Yeah, the numbers yourself, but the same numbers I've used. So just say $1,000 in bank one, but then you can use whatever reserve ratio you want, 10%, 15%, 5%, 20%, whatever you want. So as I said, so normally you can even put $100 in. Normally $1,000 is just nice and easy. Okay, but yes, the numbers would be yourselves, yes, and also yourself would be. I might write that down. Okay, so yeah, so deposit number yourself and the required reserve yourself. Okay. So this is just answering a query. I'll just give it to everyone though. So you put the deposit number yourself. So I said, whether it's $500 deposit, 1,000, 100,000, a million, whatever you want, and you choose the reserve as well, 5%, 10%, 15%. And I want, if it comes, two banks. Okay. So I was going to say, yep, not a problem. And just one more thing I want to add. If you really want a very, very high-end answer, I would also expect some mention of this. And because it's an exam, I'm not expecting necessarily both, but one of these would be good. More so, to be honest, the second one, if I was to be honest, some mention about the money multiplier. Okay. Remember, SMM is the simple money multiplier. TMM is the true money multiplier. And of those two, I would prefer the second one, the TMM, because that also has those two other aspects. Remember, it also has currency holdings and excess reserves, because they also impact money creation, and this would be about money creation. Okay. Endogenous, okay, endogenous. So what was the ordering here? So we just worked out the ordering for exogenous. What was the ordering for endogenous? What was that? Yep. Okay, you're right. Okay, I was going to add just one more thing, but that's okay. And I'll explain it in my comment to everyone, okay? But you're right. Like, you wouldn't lose a mark. All right. And if you didn't have demand for credit, that's fine, because really demand for credit is also in exogenous, so we don't talk about that. So you wouldn't lose any marks for that, okay? So don't worry. But you're right. It's the loan's getting made. Getting made's not great, but a loan is being provided. Then we said at the time of the loan, at the same time, simultaneously, the deposit in the borrower's bank account for the same amount of money. And then we say reserves are after. So at the very least, this should be the foundation for your answer, okay? Obviously, you mentioned more than this, as in you expand on this, but this is the key parts. There's also another aspect I would expect in your response. And that's this. What is the role of the central bank in money creation under endogenous theory? So what is that, very briefly, as in, and then obviously I'll add just a little bit more to that. And how do we know what we say? So if you say it's a big role, why is it a big role? If you say it's a small role, why is it small, etc.? Excellent, thank you. There's one thing I would add to that. I'll write what you write, but I'll also just add another thing to it, okay? So I've received saying very little role, which is correct. And the role is adjusting the cash rate, which again is correct, so well done, excellent. The only thing I would add is the following, okay? And again, I did ask you for a small answer, so you probably know this already, but I would add this. Adjusting. Yep. All right, I'm just going to put this through. Again, I'm not saying you didn't know this, but I would also expect this as well in a very good answer. Okay. So very little role. You're right. What is it role? What's basically adjusting the cash rate, because then you'd explain why that's a little role. And you say that influences loans, as in the interest rate on loans, which influences demand for credit. So that's my point. So you still need to explain it, okay, what the cash rate can do. How does the cash rate impact demand for credit? So you still need to explain that, okay, which is fine, but you would do that in an answer. But then also talk about how money can be created without, okay, a change in the money base. And that's basically because reserves are not considered until after the loan. So you need to make that link back to the reserves, okay? So the money base doesn't have to change for money to be created. Why? Because reserves are considered after loans are made. And remember, when the loan is made is when money is created. So you just need to link it back, link everything together. Okay, I'm always got cognizant of the time because we've only got another hour or so. All right. Normally, again, if, I'm not saying it's coming, but if, okay, I always have to say that because if this question comes on an exam, normally it's regarding like what are the assumptions, but more importantly, it's about this. And I'll explain what I mean. So hang on, I'll say it. This is normally how it comes. I'll write it this way. So if it's section 1, okay, so I'm just saying, normally, remember in the exam I said section 1, there's key terms, you give maybe 3, 4, 5 lines, that's all, one short paragraph. So I'm saying if these topics come up in section 1, normally it's just about, give me 2 assumptions. Each have 3 or 4 assumptions, roughly, not all. And I say, name me 2 assumptions, explain 2 assumptions. But if one of these topics come up in section 2, which is your 10 marks question, normally it's saying, okay, and it'll give you 2 of them. It might say expectations and segmented, or expectations and liquidity, or segmented and liquidity. So it normally gives you 2 and says for each one, explain the shape and slope of the yield curve. So what's on the slide, obviously, is the bare minimum, absolute bare minimum. Even then, you probably won't pass just by putting this. Because why? You still need to provide examples and to expand it more. So for expectations theory, so what's on the slide now is the shape. I think you may be back to me. Okay. So what's on the slide now is regarding the shape and slope of the yield curve. Okay. So the shape and slope of the yield curve. So remember the key about expectations. So I'm just going to point at the slide. It's not enough to say short-term rates and long-term rates. If you mention short-term and long-term without explaining what's on here, you will not get a good mark. So let me just be clear. You can talk about long-term, that's okay. But when you talk about long-term, you have to say that it's a collection of shorter-term rates. If all you say is short-term and long-term, you're not going to get a good mark at all, okay? Because the whole point of expectations theory is what's in here, as in the very most significant point, I should say. So shape and slope is all about, remember we said this many times when we had our class. And it's on your slide anyway, but always remember this. It's all about short-term rates, all about short-term rates. And there's the current and expected future. So you can mention the word long-term rates, but then link back. Okay, so you can mention the word long-term rates, that's okay. But you got to link it to the short-term rates. So it's a collection of the short-term rates. And then as with exogenous, I would expect a numerical example. Now, you don't have to give 5 years like we did in class, but maybe just 2 or 3. Okay? So remember, all you need to say is, you just say current rate equals, 6%. Something like that. Current rate, remember they're all short-term rates. So I really should say current short-term rate. Current short-term rate 6%, the next short-term rate 7, and the following one's 8. And then tell me how we get that. So say, okay, year 1 equals current rate, so that's no problem. So that's 6%. Well, apologies for the spelling. Year 2 is 1 plus 2 divided by 2. Okay, it's just something like that. So you'd have to give a numerical example of it. And then you mention that, you give just, say maybe 2-3 years, and then say they do that over time, and they join up the normal yield curve based on those results. So 6, 6.5, 7, 7.5, 8, etc., and it goes over time. But you would also have to say this. So when you're drawing the normal yield curve, you'll notice it increases quite a lot early on, but then it flattens out. So you just have to say that, yes, it's increasing over time, but as we go more forward into time, the increases are not as steep, not as great, but still increases. All right, segmented. Can someone, well, I can't tell you. I was going to say, can someone tell me, but it's on the slide. Okay, so segmented. So normally you might do the 3 that we did, which was, if you can remember, small. Yeah, absolutely. I'll say that to everyone though. Yeah, because remember in section 1, what I said, let me put this through the chat because it's in there. So I'll talk about that soon. Remember, if in section 1, it will not be about the shape and the slope, okay? Will not. I said before, if it's in section 1, it's just about an assumption, okay? It might say, give me 2 assumptions. So no need for numerical examples there. Right? So segmented markets. Remember when we spoke about it, we divide into 3 segments: small, medium, and long term. So small, medium, and long term. What's missing here? When I say here on the slide, what's not, which is important, but what's not on the slide? Can someone take a look at? So look where my mouse is. So take a look at this, what's provided here. And how can we be, I guess this is the question. How can we be more specific if this was a question in the exam? No, okay. I'm saying that there's something missing that's important, I think, for your response. Not making a word more specific, but there's something. Okay, let me be a bit more. See, it says here, exist along the maturity spectrum. We can all see this, hopefully. See, exist. Can someone be more specific? Because you'll need to be in your answer. Remember, your answer, you expand. So what did we say about supply and demand? And what does it impact? What does it not impact? I'll just do this, see if this gives it away. This. Does anyone remember from 8 weeks ago what that meant? If not, of course, I'll type it up on the chats. It's okay if not, because I said I know there's still another almost 2 weeks before your exam. But so supply and demand impacts yield curve. And this is the important part. This is what I meant when I did these 3 things, okay? Remember, it's supply and demand, but it's only in that segmented market. Remember, we said supply and demand only impacts in, if it's short term. If there's a change in supply and demand in the medium term, it only impacts medium term. If it's in the long term, it only impacts long term. So what I'm saying also is this: I would expect in an exam response, this is section 2, okay? Not section 1, section 2. So if we're saying supply and demand in one part of the market impacts the shape and slope of the yield curve in that part of the market and does not impact the other, at some stage we'll need to talk about what I just put through in the chats, discontinuity, remember? So it changes, then stops. Why does it stop? New segmented market. So remember saying this is just a very, very, very brief things on this slide. You need to expand and go further. Okay. Liquidity premium. Hopefully I'm not going too quick, but we're at the halfway mark and we're a bit behind, so I might have to go a bit quicker even going forward. Liquidity premium, again, for section 2 will be about shape and slope of the yield curve. Here, just like in expectation example, remember I said the numerical example. So for example, in segmented markets, you might want to even draw only changes, so therefore the short-term yield curve only changes. Remember, it is paper-based, so you can do this. For the segmented. For expectations, for liquidity premium, okay? So again, how would you approach an exam answer? The same way with expectations, as in, because it has part of it as part of expectation. Remember in expectations, we said, this is the current rate. the next short-term rate, the one after, but you'll also now have to add the compensation part. And it's okay if you get it from the lecture slides, that's okay. You know, that's fine. You know, because what you need to know, you need to remember this about the compensation. That there's no compensation in that first year, remember? Because it's already liquid. Remember, the compensation is for a lack of liquidity. So compensation comes in year 2, year 3, year 4. So in other words, the first year rate, the year 1 rate would still be 6% like we did in expectations. Why? 6 plus 0. Then you explain why it's 0. And you just explain it the way I did in that chat. No compensation because it's the first 12 months already considered liquidity. So no liquidity problem. And then in year 2, maybe, you know, there is now a liquidity problem, so they need a compensation. So if you go back to the expectations example, you'll go 6 plus 7 divided by 2 plus the compensation. I think in the lecture note we use 0.25% or something, but whatever number you use is fine as long as I can see it, or the person marking your exam as well as me can see it clearly. Okay. All right. Very interesting this. What do I mean by very interesting this? I probably mentioned this to you in lecture 5, but you would have forgotten by now. Again, I can only keep saying if this question comes, because, you know, I can't tell you what will come, but if this question comes, again, maybe this isn't as bad. What I mean by as bad, maybe it's only about maybe 10% of students, so not like 30% with that money demand question I mentioned before, but maybe 10% students roughly, all you know, I'd like to lie and say that's, but it is actual fact. Around 10%, if this question comes on, and I'll explain what the question is, as in a bit more detail. They give me a good answer, you know, they go through the things, but the wrong direction. So what do I mean by the wrong direction? Normally, if this question comes up, so you can see this question is about the transmission mechanism, it gives you a direction. So I'll either say this or the other. So the question will either be, so when I say this or the other, it only gives you one. That's what I mean by, it won't say in the question increase or decrease. It'll either say, the question, if the question comes, will either say an increase in the cash rate, or it'll say decrease. Yep. Yeah, okay, yeah. So with the final one, I'm correcting about half of them, but the other half I moderate. So moderate means I then check to make sure the marking is appropriate. Yeah. Okay, so again, what I'm saying is, you know, you might be, again, if this comes on the test, or the exam, sorry, it will give you one direction and only one direction. Again, so all I'm saying is just to be aware of this, make sure when you're answering the question, okay, that you then answer it in the correct direction. And answer in the opposite direction, no matter how good the answer is, okay, no matter how good, will give you 0 out of 10. Because it shows that you just then failed to understand the question. And maybe you memorized an answer and you just thought, okay, I'm going to put that in anyway. So you get 0. So what's this one about? Okay, we should know, we can see here interest rates decline, lending rates decline. So this is about obviously the cash rate decreasing. So, sorry. I did give a numerical example of liquidity. Oh, liquidity premium. Okay, sorry, not liquidity. All right. Okay. So current rate, I'm just answering it. I'm giving this to everyone though. Someone wanted a numerical example of liquidity. So current short-term rate, 6%. Next short-term rate was 7%. Following short-term rate, I think we'll say 8%. And then I'm just going to put this in 3 stages, okay? So first, again, I'm just answering a student's query for everyone else regarding an example of liquidity premium. So at the start, you'll give me the rates, and then you'll give the compensation rates, okay? So compensation rates, then you say year 1, maybe 0%, year 2, 0.25%, year 3, I think it was 0.5%. This is 0.5%. Okay, so, and then what you do is need to combine the two. So then you'll say, okay, year 1 rate, as in the final rate, let me type that in, would equal 6 plus 0, which equals 6%. Year 2 rate equals 6 plus 7 divided by 2 equals 6.5 plus the compensation, which was 0.25, 0.25 compensation equals 6.7. I won't do the third year, but that's how you'll do it, okay? So year 3 will be 6 plus 7. Yep, okay, not a problem. That's okay, no worries. All right, so going back to this one, it's regarding direction. So be very careful about the directions, okay? So what is the question asking? Is it increasing the cash rate? Is it decreasing? And then you'd have to go through and mention the 2 sectors of the economy, okay? And we can see here, so it's nothing new that I'm saying, but it's the financial sector. And so all I'm saying is that in your response, I mean, I don't necessarily, believe it or not, some students, actually, if this question comes, also write down, as in put down the diagram. That's not necessary, okay? So you don't have to give me the diagram, but you have to explain the stages of the diagram. So you do what occurs at the start. You say, well, the central bank is buying securities. What's occurring with the cash rate? Cash rate will then decrease. Why is the cash rate decreasing? Because they want to increase economic activity. So that's basic economic principles. The important part of your answer, well, okay, the important part of the answer first is getting this direction right, obviously. Because as I said, if you get the direction wrong, you get 0 marks. So must make sure you get your direction right. Then, as I said, the 2 sectors of the economy I want to explain. So you'd explain as the financial sector and then the real sector. So again, given that this is cash rate decreasing, interest rates going down, economic activity increasing, you then have to talk about the financial sector here. So what's the financial sector? Well, it's the financial markets, exchange rates, and the banks, the financial institutions, they're lending. And you'd have to make this connection, interest rates with market value. Okay, so when I say make the connection, between you'd also have to explain what that connection or direction is, okay? And that's that inverse. So interest rates go down, market already residential construction. The thing maybe I want you, no. Sorry, I shouldn't say no. I'll explain what the question is. Someone's put through, do we need to use numbers as examples here? No, you don't. No. But you do need to say about going up and down, that's all. Okay. So you will be given, I'm getting a few questions now. Okay. You will be given a question that says, which if, I keep having to saying if first. If this question comes up, you'll be given direction, which is either increase or decrease. Yeah, as I said, when you start the question, you should be saying, let's say, for example, it's a decrease in cash rate. In your answer at the start, you should be saying there's a decrease in cash rate to want to increase the economic activity because economic activity's been too slow. So that's all you need to say about that, okay? So the question I was answering, let me go back to the charts. Yeah, so do we need to explain why changes in cash rates leads to changes in interest rates? No, you don't need to explain why it does, although okay. So the question is why let me go through more, I'm getting 3 or 4 now. So the first part is this, let me go one at a time. if you're given a direction about cash rates, increasing cash rate, then explain why there's been an increase in cash rate. And all you need to say here, if it's an increase in cash rate, we're trying to slow down the economy because the economy is going too quick. If there's a decrease in cash rate, when I say we, the central bank, is trying to increase economic activity because the economic growth is too low. So that's how you would start it generally, okay? So that's the first one. We need to explain. Okay. The next part is, let me go to the next, everyone in the meeting. I might give this also to everyone. You would say, so one question now is regarding, do we need to explain why the change in cash rate leads to changes in interest rates? All you'd have to say for that is the following, something like this, okay? When cash rate changes via the central bank, it is expected that interest rates will also change in the same. So you just give a very, so to answer your question, you're giving a very generic answer to that, okay? So you just say when it changes, when cash rate changes, there's an expectation that other interest rates throughout the economy will change, because that's how monetary policy works, okay? So just keep it nice and general, and that's fine. Let's see if I can go to the next. No, okay. I said, okay. I'm just going to put this for everyone. So I just want to be clear about this because I don't want to disadvantage people. Okay. No, having a diagram will not lead. I said, if you want to put that in, that's fine, because that might help you, but it's not going to give you a higher mark. So it's up to you whether you want to do that or not. That's why. Okay. Because I'm not going to disadvantage people for not putting it in. So it's about the explanation. Okay. Yep, I'm getting to that. I've had a few queries. Don't worry. All right. The next one is, I think I've got 2 queries left. Okay. Let me get to it. We need only to state the result. Just like RBA lowers the cash rate. Yeah, that's what I'm saying. Yeah. Okay. Yeah. Exactly that. Just say generally, the central bank lowers the cash rate to increase the economy, and the expectation is that interest rates go down. Yep, that's fine. Not a problem. Okay. And I think there's one more. Yep. Okay. Not a problem. Let me go back to everyone. When buying securities why buying securities means. Okay. This goes back to understanding monetary policy. So when the central bank, I mean, this isn't important if this question comes up, but it's just maybe good to know anyway, okay? So when central bank decides to buy securities, it is forcing a purchase with commercial banks. Hang on. I mean, this is the framework. Just let me answer the one before, then I'll get to your query. All right. This is a query regarding about the buying securities and how does that increase money supply. It goes back to what monetary policy is about. Remember, the central bank can still create money. Okay, it's a very small one, but they can create money via the purchasing of securities from commercial banks. So they force the commercial banks. So in other words, they buy it from the commercial banks. This forces a transfer of funds from the central bank to the commercial bank, if we go back to that lecture. And now the commercial banks now have these extra funds. And remember what we said in that lecture. They try to keep these funds at a minimum because if they have too much, they get punished via a penalty rate. But these are things you don't have to know for this question. But because they'll get punished with a penalty rate, which is below the cash rate, they then are forced then to lend those funds out into the market, which results in more money being supplied than before. But you don't have to, you would not, okay, there would be no expectation for you to put that into your question. All right, hi teacher, I'm a little confused about, what do you mean? So now I'm confused with your thing. You said, can you provide me an answer framework? Okay, I'll try to do it via the chats and see if this answers your question, okay? I'll try to do it via the chats. So an answer framework, okay. So in other words, I think you're probably saying, if you would answer it, how would you answer it? I assume that's what you're saying. Okay. So, cash rate increase. Okay. I'll try to just try to keep an eye on the time. We've only got about half an hour left. Just okay. Cash rate increase. Try to restrain economy. Money supply decrease. Remember, you want to reduce inflation. Money supply decrease. All right. So normally I'll just say maybe very broadly like that. Then I'll say, okay. For the financial sector, increase cash rate leads to increases. I've got to be careful how much I write here. I don't want to give you the whole answer. So, I'm not going to give too much. I'm going to say interest rates exchange. I'll give you exchange rates because I haven't spoken about exchange rates. Actually, I'm going to stop after this. Because then I am giving you the answer, which is not what I want to do. Because more treatment. So that's how you're going to have to go through it, okay? Like I'm not going to go through, because the reason why I'm saying, because the question was just say all other students are understanding. They're saying, can you give an answer framework? My real answer to that is this diagram is your answer framework. So you just need to explain all these steps that are going through. So if the cash rate is increasing or decreasing, you then need to talk about these instances. So in the financial sector, you'll say, okay, If the cash rate goes down, the lending rate in the bank goes down. Exchange rates decline. Why does the exchange rate decline? Because when interest rates go down, we become less attractive for foreign investors, for overseas investors. So they reduce their investments in Australia. Our Australian dollar loses value. Okay. And then you say, well, if interest rates in the banks go down, what's going to happen? People borrow more money. So you say in the real sector, consumers spend more money because we borrow more money. Businesses spend more money because they borrow more money. And construction just means housing, okay? Housing increases because it's cheaper to borrow money. What happens to GDP? Well, go back to what the cash rate is about. Cash rate's going down because we want economic activity to go up. So you say, as a result of all this, our GDP goes up. How much does it go up? Well, again, we're not giving any numerical numbers. We're not giving a numerical example. So we'll just say that GDP will increase. And then you say, well, okay, the closer we are to full employment. Okay, all right. Well, okay, so the question is, do I mention, just say everyone knows, do I mention all the financial rules sectors when entering? Or am I able to mention some of them like what? Remember, I'm just giving you a general example. Obviously, in your response, okay, the expectation will be to explain the entire diagram. Now, let's say you're explaining, in your response, okay? So the person who sent me the message, let's say you miss out financial markets and value of securities. Let's say you miss that out, as in it's not part of your response. Well, obviously you'll get a lower mark, but you'll still get a good mark because you've still mentioned most of it, okay? So all of these should be covered. Yes, okay. I think we're missing the point of this question. All right. All right. Maybe I misled you guys. So I'll apologize for that. But the question is about this. So I think we've maybe missed the point of this question. The question is, even though I've been saying increase cash rate, decrease cash rate, the question, if it comes in section 2, would be about the transmission mechanism. And what we're seeing here in the diagram is the transmission mechanism. So a top answer, the expectation would be that this is all covered. Okay. So again, if you are going to miss out on aspects, which happens, it happens all the time, it does, then you would obviously get a reduced mark. Now, obviously, even if you include everything, it all depends in any exam, the level of explanation. Okay, those who explain it in greater detail will obviously get higher marks. So again, someone's asked me about the word count. There are no word limitations, but as I said, you need to use a rule of thumb that I mentioned at the start of this class. Think of it like 5 questions, 10 marks each, even though we know there's 4 questions, 10 marks, and there's one question that has 5 parts, 2 marks each. But think of it like 5 questions, 10 marks each. That's 24 minutes for each 10 marks. So give yourself 3-4 minutes to make a plan, which we'll talk about shortly, hopefully. 3-4 minutes to make a plan for your response, and 20 minutes to write a question. Now, in the 10 years I've been doing this, or 10 plus years I've been doing this, because, you get the exam booklets. I'm just trying to think out loud. I would say very rare, okay, let me be. If there's no diagram, okay, because remember the diagram, you don't need it. If there's no diagram, it's very, very rare for an answer to be more than a page, no matter what the question. Okay, I'm talking about in the booklets that you get. Okay, very rare. All right. Obviously, if you have the diagram, then obviously it's going to make the question longer. But without a diagram, it will be rare to get more than a page, even with this type of question. Okay. Again, I'm not going to tell you exactly how many words you use. Just use a rule of thumb. Okay. 3-4 minutes to plan your answer, 20 minutes to write it. And again, so going back to your question, there are no word limitations. But as I'm going to mention at the very end of this session, which I might have to skip a few slides to do, I'll put these slides up on Collaborate. I might make the point now because we're getting a bit late. This always helps with exams, no matter, especially in a theory exam. Okay, direct, concisely just means get straight to the point. Okay, get straight to the point. Any part of your answer that's not related to the question is not important. Okay, but we'll get to that at the end when I give you an example. All right. 12:30. So let me just do this for 1 sec. So, excuse me. Just need to take a look at one thing just regarding where we are time-wise in the slides. So just hang on 1 sec, see how far behind we're 11. All right, okay. Guys, I'm going to have to, sorry. I think I'm going to have to go a lot quicker because I also have to kind of head out by around 1-ish, 1 my time. All right, all right, sources and use of funds. That was going to be another potential topic for your exam, sources and use of funds. All right. Normally when these questions come, normally, they might ask you for a couple of, again, if it comes. Normally, and not always. I'm not, again, always. I'm not guaranteeing this, but normally, I would ask for. So that should be 2. Sorry, guys. 2 main sources, 2 main uses. Now, obviously, because this is about banks, you know, commercial banks. So obviously, the main use is always going to be about loans, and all you got to do is say, you know, banks' primary use of funds is making loans, and normally they make loans for housing and personal consumer loans. Or you can say housing and business loans, as long as housing is in there, because housing is the major loan. Housing means mortgages, okay? The only thing you might want to say, because remember, all right, I'll put this. So the 2 main uses should be, okay, should be loans and investments. Again, sorry for the typing, but the loans will be mortgages, which is, you know, for houses, and then you say consumer and business loans, okay? For investments, you are able to write other things, but remember, I'm just saying in our focus, from what I remember from the lecture notes, our focus now, understand what I'm about to say now. Just because our focus was on government securities, if you remember when we did investments, the focus was government securities, and we said short-term securities, long-term securities, it doesn't mean you have to use that as an example for a bank's investment. If you want to use another example, that's fine. Okay, but that will be up to you as to which ones you use. Normally, it's a bit safer to stick with what we've learnt in class, but again, that will be up to you. So my point is you don't get penalized if you pick another investment, as long as that investment is appropriate, okay? But I'm saying in our class, if you remember, we focus narrowly on government securities. Use of funds, sorry, source of funds. Would have to be, again, I'm talking about the 2 main sources, would have to be deposits and, okay, would have to be those 2. So in the deposit, you'll just mention the 4 that are there. So examples of this are transaction deposits, saving deposits, term deposits, and NCT. And then what I would kind of expect is to say how, if you're going to mention deposits, which you would, okay, you mentioned about the interest maturity trade-off. So roughly, what was that? Roughly? Then transaction and save. Remember, you need to be expanding a lot more. I'm just giving you the brief bones of it. You need to expand it. But so you talk about interest, you talk about deposits as a major source of funding. Remember, roughly it's about 60%, roughly, deposits. Okay, so it's roughly 60% of the source of funding. And you mentioned those four main types there. Then you say that the interest rates with transactions and savings will be lower than against a term deposit. You mentioned why, because of the maturity, liquidity, etc. And then you mention the NCD briefly. So remember, the NCD is a negotiable certificate of deposit. And the only thing I'll be expecting is okay, so all I'm going to say is talk about. When I say talk, obviously you write, you don't actually talk. Talk about this value issued at a discount. Talk. All right, write about face value. Issue at a discount, transfer of ownership. All right, just to for myself, I'll say at a minimum, which means at least. Okay. So if you're talking about NCD, negotiable certificates of deposit, at a minimum, you talk about what the face value is. And remember, these are normally very short-term investment, short-term deposits. Sorry, short-term as well. You'd mentioned that. And what it does it mean about being issued at a discount? Remember, it's a discount to face value. So if the face value is $1 million, maybe it gets issued at $950,000. What does that mean? That the bank is raising $950,000. It's the DSU. The bank is the DSU because they're trying to raise money. So someone buys it for $950,000, and if it's for 3 months, it means that in 3 months' time they get the face value. What's the face value? $1 million. But you can transfer it. So I can sell it after a month to somebody else. They can sell it to somebody else. They can sell it to somebody else. Whoever has it on day 90, if it's a 3-month instrument, okay? Yeah, that's what I'm saying. We're just explaining it generally. Yeah. So I'm just saying when it comes to what I said is how you would answer it is to say transaction and saving have it's on demand, so it has low interest. Term deposits, longer term, have higher interest. So that's how you'd explain that. And then the NCD, you'll explain it just the way I put it in the comment just now. Okay. So what I've put about is the discount value, the face value, how it transfers ownership. And then whoever has it on day 90 or whatever day you pick, 60, 120, they get the money from the bank. Okay. Yeah. So the answer is yes, you'll need to explain that. Okay, but remember, explain it the way I've just put it through in the chats. I've already put that through in the chats, how you would explain it. Wholesale funding. Think of it, what you'll need to explain at some stage is short term, long term. Okay, so I would expect, now I'm just putting through it for the wholesale funding guy, for wholesale funding. So as we've talked about, remember we said, oh, sorry, I would have said it in my class in Melbourne because these classes I didn't teach you, but we would have said about the four main types of wholesale funding. Just think short-term, long-term, so money capital, as in money capital markets, short-term, long-term. And in short-term, you've got short-term domestic, short-term international, you've got long-term domestic, long-term international, okay? So speak broadly about that. And that this equates to around 30% of the funding for banks. And then what I would say, and this came out, the last point now that I mentioned, this came out after the GFC, so the global financial crisis we call in Australia. In America, they call it the Great Recession, but from 2007, 2008, is that the supervisory body showed that short-term wholesale funding was very volatile. And you probably won't remember because you're too young, but at the time of the GFC, the short-term markets, they froze, so banks couldn't access money there. So as a result, Basel III came. What they did is they said Basel III, which is the supervisory body for all banks, the international body, said, well, you need to reduce, so just what I've put in the chat there, you need to reduce your reliance on short-term funding. And then if you go back to that lecture, lecture 7, I think it was, you'd see that after the GFC, short-term wholesale funding went down and deposits went up. And that was because of Basel III, what Basel III said. So you'd mention about wholesale funding, short-term, long-term, domestic, international, and then you say that there's been a reduction in short-term wholesale funding. Why? Because of the volatility, too much volatility, not good for banks. Loan commitments, letters of credit. Again, if this comes, normally you're asked to explain what's a loan commitment. So you'll give one of these 3 examples. Normally I don't ask for more than one. So again, just look at where my mouse is. So see, it says line of credit, term loan, revolving credit. This is basically from your slide. Again, normally if this question comes, you're asked to explain one of them. Okay, one of them. And normally, again, it just asks you to explain one. It won't say explain line of credit or explain term loan or explain revolving credit. It will just say give an example of a loan commitment, and then you can use one of those 3. Okay? So again, normally, whoa, should be in my chats. Something's funny. 30% of funding for banks. It's raising money, yeah? I guess there's a joke here, I don't know. Remember, all I'm saying that 30% in raising money. So banks raising money for balance sheet activities. Is that just B? Is that banks? What's going on? I assume there's a joke there somewhere. Yep. Right. Okay. Because I can't read Mandarin, so I don't know what I was saying. All right. Anyway, the point I'm trying to make is this, which is the correct point. To raise funds, it's done 2 main ways, deposits and borrowed funds. Roughly 60%, it's a bit more, but roughly 60% is deposits, and roughly 30% is done via borrowed money, borrowed funds, okay? And you'll find that 8% is done via equity. So I'm not sure why it caused so much laughter, but it has. All right, normally you ask to explain. All right, that's throwing me a bit. Normally you ask to explain low commitment by the use of an example. It can be one of the three. Am I missing something? Should I be? You know what I'm going to do? Just to humor myself, I'm going to take a photo of that comment because my wife is actually Chinese, and I'll show it to her and see if it was funny or not. And then I might laugh a bit later in class, in a couple of hours when I show her. But anyway, normally you ask to explain low commitment. Okay, get back to something serious now. All right, so what I'm saying, if this question comes, okay, normally say, okay, this, explain what is a loan commitment. So you say generally what's a loan commitment, about the bank making a commitment to a business, one of its business clients normally, okay? And then you'll be asked to give an example, normally. And again, you can pick one of the three that are there, that's fine. And then you'll see this last part about funding risk and liquidity, restraining liquidity. Can anybody tell me this last point here? So again, if you look where my mouse is, it says exposure to funding risk, which can strain bank liquidity. Does anyone want to maybe think as to what that could refer to? Like, what did you learn in class, I guess is what I'm trying to say. Oh, yeah, sorry, okay. Yeah, if it does come, again, if, I got to keep saying if, excuse me, if it does come, it's a section 2 question. Okay, you always need to, okay, maybe you should always know this, especially for a theory unit. You should know that lecture notes, okay. Yes, I said you need to explain loan commitment. That's what I said at the start. You'll be asked to explain loan commitment, okay? And then you'd have to do it via an example. So if you looked at the comments I put before, that's what I said. You need to explain what loan commitment is firstly, and then you're asked to use one of the examples to explain. Yeah, so explain what it is and then give a specific example. I think I just might have to make this a general notice to everyone. You should know this anyway, but I'm just going to, yeah, I ask for one example. If it comes, I ask for one example. That's what I'm saying. Okay, I'm going to just type this as a general comment, okay? And I'm going to explain why I've put this comment here. All right. No matter what class you're doing, but more so for theory, but no matter what class you're doing, your lecture notes is not all the information on that you should know. The lecture notes is just a summary of the information, okay? Yeah. What I've said a few times is that I just ask for one example, you pick the example. Again, if it comes, okay? Normally I say use an example. No, I'll say something like, what's loan commitment? So you explain loan commitment generally, what it is. Excuse me. And then I say, provide an example for that. And then you pick the example you want. All right, so let me just go back to my point about the lecture notes, okay? Because this is also seems to be a theme among students as well. So I'll try to be brief, although it's already late. Lecture notes are only a summary of information from your readings, just a summary, okay? So in the lecture notes, when you're responding in your exam, okay, when you're responding in your exam, if you're giving me information that's basically just a copy of the lecture notes, all right, you're not going to get a great mark anyway. Okay, it's not going to be a great mark because the more detailed information is obviously in the readings. Okay, and that's the expectations for the very high marks that you'll be getting. You'll need to go beyond the lecture notes, not beyond the readings. Use the readings, but you need to go beyond the lecture notes. Do we understand that? That should be for all subjects you take. Lecture notes are just a summary of information. We try to present it and explain it in class, but the detailed information's in the readings, okay? All right. Are you going to force me to go back? Come on. Let me just go back, okay? Let me do something. I've just received the question. I'll answer it. Just let me go back to the slides and now check. I need to go back to the very start now to see what did I put in my topic. Okay, all right. I understand. That sorry, will the other two activities, securitization and derivative, not be in the exam? Just for this answer. No one's answered my initial question, which was about this straining liquidity. Can anyone? Okay, maybe someone's responded from it. Let me just check the chats. Nope, no one responded. All right. So we're talking about straining liquidity on commitments. Can anyone posit as to what a response for that would be? How can that occur? Like what? That should be and loan commitments. So I'm just looking at that last point, exposure to funding risk, which can strain bank liquidity. Okay. Just bear that in mind because we're just running out of time now. I don't know how. It's 12:56. We may have to go just a little bit over time, even though I'm supposed to be somewhere else. All right. But letter of credit. All right. What are the key things you need? All right. 3 parties: bank, bank customer, beneficiary. Okay. The beneficiary is also known as a third party. So in both instances, a letter of credit is the bank guaranteeing on behalf of its customer. All right. So for a commercial, oh, that should just be place. Okay, so commercial letter of credit. So you always have 3 parties: the bank, the bank's customer, and what we call a third party or a beneficiary. So in the first instance, commercial letter of credit, what's happening is you have 2 parties: the bank's customer, who's normally a business, okay, and the party from overseas, and maybe the bank's customer wants to purchase something from overseas, but overseas does not want to ship those goods because they've never had a relationship before, so it doesn't trust them that they're going to pay. So they don't want to ship because they don't know the bank's customer. But the bank's customer needs those goods. So the bank's customer, which is a business, goes to the bank and says, can you guarantee to that third party that if I don't pay for whatever reason, you will pay on my behalf? Okay, so that's basically it. So the bank offers this service. It's called a letter of credit. To offer this service, the bank receives a fee from the bank's customer. The overseas, the third party will now give the goods to the bank's customer because it knows that even if the bank's customer does not pay, who's going to pay? The bank. So this is what we call a contingent liability. Why? If the bank customer does not pay, then the bank is liable for payment. Oh, you don't know that yet? Oh, I thought your local teacher would have, because I'm going to put an announcement tonight with a sample with these notes. No, it's paper-based. Test is paper-based, not online. You should, do you know the date? Have you been given the date or not? I assume you've been given all the details, no? I'll confirm it with your local lecturer, but it's definitely paper-based and the date's already also been given to you. It should be the 30th. Okay, the 30th of May. No. Sorry, no. A question came up from a student. Will derivatives be tested in the exam? As I said before to the other student, if there's going to be something on OBS, off-balance sheet activities, it'll either be loan commitments or letter of credit. All right. Okay. It's already 1 o'clock, so all right. NBFIs, non-bank financial institutions. Again, what? Oh, better go back in the chats. I really have to go very quickly on these ones, guys. Sorry. 2 sources and uses. Again, if this question comes, it normally asks you for the 2 main sources and main uses of funds. Okay. Or sometimes it just asks for the main sources and use of funds, but that's kind of how the question is. So what do we know? The last 2, credit unions and building societies, are ADIs, authorized deposit taking institutions. So what's the main way they raise funds? Deposits. Okay. So normally it's either 2 sources or it says the main source. Okay, the main source of use and use of funds. So this is typically a fairly straightforward question. The only thing that tends to happen each semester is the following problem. Okay. So with life insurance and general insurance, okay, it's important. I'm about to type something now because again, every semester this happens to be a problem. Okay, not for a lot of students, but for some. So look, when it talks about use of funds, okay. Now in your class, hopefully, so the use of funds refers to how a fund's used to make money. So why is this important? It's important for the following reasons. Paying claims. Remember, we're talking about life insurance, general insurance. They're insurance companies. So people make claims and they pay out. They give a payout. This is not a use of fund in our class or in this subject. This is a very important thing to do because it tends to be a similar thing each semester. So if you get a question like this, and if the examples are life insurance and general insurance, and it says explain their use of funds, and you say, okay, I know, use of funds, they used to pay claims. You get that part of the answer incorrect. Because yes, that is how they use that money, but we're talking use of funds as to how do these companies make more money. So what's the use of funds for life insurance and general insurance? Well, it's investments. Okay, so use of funds. Remember, we're talking about life insurance in general. Okay, use of funds is their investments. It's not paying out claims. So just very important to understand that distinction. And then we should know that life insurance So that comment I just put, why is that the case? Can someone explain to me very briefly why is that? So life insurance, I said, most of the use of funds is, so they invest long-term, short-term, but most of it's long-term. General insurance, they invest, but mostly short-term, but also, of course, some long-term. So in your answer, you would say long-term and short-term. You'd say both, of course, but you'd say mostly long-term for life insurance, mostly short-term for general. But general also does long-term. But so why is, in your explanation, you would also have to tell me why the above. Why is that the case? Okay, why? Do we know why? Okay, it has to do with their outflows. Outflows equals payments of claims. Yes, if, again, when you say will, excellent, good. Yes, as in, sorry, I'm just responding to a question that's given to me. It said, would this question be a 10-mark question? If it appears, if, then it's a 10-mark. It's a section 2 type question. I've got the response. That's great, which is because life insurance cash flow is stable. When we say cash flow, which is just a bit more specific, I would have said their outflows, okay, are predictable and stable. Remember, the outflows are the payments of claims. So because life insurance outflows are predictable and stable, they can afford to invest long-term. Whereas general insurance, their outflows are not predictable, which means they might get a lot of claims in 1 year, so they need money to pay that out. So how can they access that money? Well, if they have a lot of short-term investments, they can sell their short-term investments, access the money, pay out the claims. Okay, so very good. All right. All right. Good. So just given the opposite, which is general insurance. Remember, the outflows are payments of claims, outflows. So because they're not predictable, because, you know, Mother Nature can happen, who knows, floods, you know, hailstorms, thunderstorms, cyclones, etc. Because these things can happen, maybe 1 year they get a lot of claims, so they need to pay out a lot of money. So because they need to maybe access that money, they have more short-term investments, they can sell them, get the cash, pay out the claims. But that's normally the main thing you need to be just aware of, okay? The other ones are fairly straightforward. Risks, okay. I'm trying to think normally how are risks asked questions. Okay. Normally, if you're given a risk question, you're given 2 risks to explain, okay? To explain 2 types of risks. And from memory, I've given you 6 risks, maybe, or maybe even 7, 6 or 7 risks in general. Okay. All right. Maybe I'll put this up. So what does short funded mean? So looking at interest rate risk, what does short funded mean? Short funded. How does short funding arise? So as you're thinking about that, I'll just be brief about credit risk. The thing is, I need to definitely head off by 1:30, so that's the most I can stay. Credit risk is the ability not to pay back loans, okay, not to pay back. So that's the credit risk. You do a credit default. And hopefully in your class, you would have learned about individual credit risk. So it's the 5 C's of credit, so individual credit risk. And all right, so for credit risk, just be aware of the 5 C's of credit. Okay, the 5 C's of credit, which was that diagram regarding how do we reduce credit risk for individuals. And all that's saying is this: we need to get as much information as we can from people who borrow money from us. Okay, we try to reduce the information gap. And that talks about information asymmetry, adverse selection. And when banks lend out to businesses and industries, say, for example, the housing industry, there's something called concentration limits. You don't want to give too many loans to one specific industry. Why? Because if that specific industry has trouble, then a lot of your loans are also going to be in trouble. So you just do portfolio. You spread your loans across different industries. You don't want too much in one industry. When there is too much in one industry, it's called concentrated. There's too much of it. So we put a limit to the concentration, hence concentration limits. All right, get back to the question I asked you. What does short funded mean? Excellent, yep. Yep. So our funding, remember, when we're trying to fund something, we're trying to raise money. It's our liability. Okay? And it's saying it's less than our use for that asset. So maybe we've raised money for 1 year, but we're using that money for a 2-year asset. Okay, so we don't have enough funds. We only funded for 1 year, but not the 2nd year. So the liability is less than the asset. So the problem is after. Why is that a problem? It's only a problem if the cost of finding that money increases. So interest rates go up, because then that it decreases our return. Okay. Long funded obviously is the opposite. So when we talk about longer and shorter, the asset maturity, so the asset maturity is being where we are investing is maybe only 1 year, but we've raised funds for 2 years, so our liability is longer. Well, the risk is at the end of one, we need to reinvest it. And what's the risk? Well, the risk is that wherever we reinvest, wherever it is, we get a lower return than we did in the previous year. Okay, so that's why it's called reinvestment risk. When it's time to reinvest that money, will we get the same return or not? If we get a lower return, that's obviously not good for us. So that's the risk. The risk is we get a lower return. So if you looked at, or sorry, not if you looked, if you discussed it in your class, you would have seen that investments are obviously interest rate based. So when it's time to reinvest in another interest-bearing asset, whatever that is, the risk is that the interest rate goes down, therefore the return on that investment will go down. Based assets, the insurance. All right. Hopefully there are some accounting students in here, maybe not. Insolvency risk, equity equals assets minus liabilities. The risk is there's not enough equity to cover your losses in assets, okay? So not enough equity, so not enough capital, not enough equity to cover a sudden decrease in assets. This is one of two ways banks fail. Banks fail due to insolvency, well, and illiquidity. Okay, banks fail. It should be banks due to that. So in other words, not having enough capital. So that's the problem, not having enough capital to absorb losses. So that's the problem. As in, when I say that's the problem, that's the risk, because we're looking at risk. How do we reduce that risk? Well, we increase the capital. Okay, so reduce the risk by holding more capital. Right, so when you looked at hopefully country risk or sovereign risk, the main thing you need to get out of it is the following. As it says there, and I'm hoping these are fairly straightforward now. So you'll just be asked to explain what the risks are and give some examples. So example of a country risk will be a government coming in and taking over a business operations, or maybe if the financial institution wants to send money back home, so the capital flows back home, maybe the government comes and stops that or limits that. It says you can't do as much. You know, maybe you can only send 20% of your funding back home, as in remittances back home. Or maybe it stops it altogether, or maybe it takes over the business. And we're just saying that once a government decides to do that, it's very, very, very hard to get the government to change its mind. Why? Because the government doesn't want to lose face in front of its people. It doesn't want to show that it's weak, that someone else put pressure on it and it changes its mind. It doesn't want to show that. So they want to remain strong. So it's hard for them to change once they've already made a decision. That's what we say here. Little chance. Okay? Once the decision made, very hard to change. But reputational risk, the most important, from your perspective, you explain what it is, but understand that it's intangible, okay? Like, how do you measure what the reputational risk is? It's hard to measure and very difficult to measure exactly. I mean, some might say, oh, goodwill, not goodwill. Oh, excuse me. Goodwill. So the accounting term goodwill, some say that might be a measure of reputation. It's not. That's more a discretionary, it's more a discretionary item, like almost like a residual type item. And it's not an exact measure of reputation, no chance. And the reason why, as I said, it's very, very difficult to measure because it's intangible, reputation. All right. All right, operational risk, mainly to do with fraud and IT. So there are already some examples in there for you. So you could probably explain it like that. And normally, yeah, okay, I would say this, FX risk, I will add this because I did say can sometimes trying to be, all right. So what I put there is FX risk can sometimes be a section 1 question. Remember, section 1 is the briefer, just give a few lines. And sometimes it might ask you to explain one of these two things in the slide here. So I'll just give an example. So like you could be explain one or the other, like you'll be given one, not saying you're given both. So you might, so a 2-mark question might just be, briefly describe net long position, briefly describe net short position. Okay? Right, changes to capital requirements. Hopefully when you went through this in class, you would have noticed the following. So if you look at here, the change and the intent of the change, okay? This first dot point here, excuse me, refers to that top dot point. This second point refers to that, the third to that third, the fourth to that. Now, if this question, just excuse me for 1 second, I just want to take a drink. My voice is starting to go. Okay. If this question does, again, if it comes on the exam, it's a section 2 question. And it normally asks you something along what's on this slide. What's the change and also what was the reason for the change, the intent of the change, okay? If it is to come up. So what do we see from Basel III? Remember, Basel III came out of the global financial crisis. And basically, okay, I'll try to be quick. After the global financial crisis, a lot of banks failed. And people were surprised because there was Basel II. And they're saying, well, why didn't Basel II work? How come? So they looked into it and they found certain reasons why Basel II wasn't strong enough. This is why Basel III came. So it made things stronger to try to protect banks going forward. So some of the changes to capital are here. Tier 1 capital went from 4% to 6%. And of that Tier 1 capital, now 4.5% had to be common equity. So what's an important part of Tier 1 capital? Okay. Okay, Tier 1 capital is first used to absorb losses. Cannot use Tier 2 until all of Tier 1 is used up. Okay? That should be Tier 2, guys, okay? Tier 2. So this is my point. Tier 1 capital is considered high quality capital. The capital absorbs, remember, absorbs the losses. When a bank experiences losses, they need to use their capital. They must use their Tier 1 capital first. They only use Tier 2 capital when Tier 1 capital is all used up, all finished. Then they can go to Tier 2 capital. This is important because of the following. Okay, as long as they're using tier one capital to absorb their losses, if they do experience a loss, they can still operate as normal. Okay, once their tier one capital is all used up and they've got to start using tier two capital, then their operations are reduced. So the supervisory body will say, okay, you're starting to use tier two capital. There are some functions that you did do before that you can no longer do. And the supervisory body will work out what those functions are, okay? The important point for you is that it's in reduced operations once they start using tier two capital. Okay, mandatory and discretionary. Okay, mandatory and discretionary. So mandatory means must, okay? So what must you have? So an additional capital conservation buffer, we can all read the slide, of 2.5%, 2.5%. All right, so what does this mean, or why is it needed? Okay, remember what I said, the third dot point here, guys, the third dot point is the third dot point here. So why is the mandatory, capital conservation buffer needed? To improve survival during a sudden industry downturn. That's why it's called a buffer. It's extra protection. That's what a buffer is. Okay, it's extra protection. The more important one for us, when I say more important, because I shouldn't say that. Mandatory is also important, but it's more straightforward, as in they must keep it in case the whole industry goes down. The discretionary one requires a bit more explanation, I should say. Discretionary means it is the discretion of the supervisory body to apply this. So I just want to be clear. Mandatory, all banks must have an additional 2.5% on top of their 8%. So that's 10.5%, must. Then there's another 2.5% that they maybe have to keep. Why maybe? Depends on the supervisory body of that country. So the question then is, how does the supervisory body say, you take an extra 2.5%, you don't? Okay, when do they use this discretion? And it's following. This is when. So supervisory body will apply the discretionary 2.5% when they believe and we call this excessive. All right. So now this is the discretionary part. So when the supervising body, say in Australia, it's APRA, Australia Prudential Regulation Authority, when the supervisory body believes they're making too many loans, excessive credit growth, too many loans, they'll say, hang on, you're making now too many loans, there's too much risk, here's an additional 2.5. So you got your 8%, you got your mandatory 2.5, which is 10.5%, plus this on top, which will take it to 13%. When do they apply it? As I say in the chat, when they believe, they being the supervisory body, believe that banks are making too many loans. Okay. All right, so because I need to head off at 1:30, guys. 1:30 my time. All right, liquidity ratios. All right, what's the main thing we need to know? Normally what I say, the main things, well, wrong area. HQLA, and you very much need to know these two areas. So it's high and I've got it written. High quality liquid assets, HQLA, net stable funding ratio, NSFR. Okay. So what did this all mean? Again, so Basel III All right. So the source of funding was seen as too volatile. So what was too volatile? It was short-term funding. Okay, short-term funding. And we saw this in our term structure when we go back to the lectures we did together. Remember? Short-term is more volatile than long-term. So banks were told to change their source of funding to make it more stable. So what happened? Deposits were increasingly used as a source of funding. Remember, like we said before, now about 60%. And wholesale funding, so borrowed funds, reduction short term. All right, almost there. All right, profit and safety dilemma. Okay. In essence, it comes down to this. Okay, this is the dilemma. So for banks to be safe, okay, to be safe, they should have a lot of cash on hand so they can give to customers when customers want that money, when they withdraw. But from a profit perspective, it's not good because if they have too much cash on hand, then they can't use that to make more money. So that's the dilemma there. Okay. Banks make money. Okay. I'll just probably put this through. So the liquidity one had to do with the cash. You should keep cash on hand so when people ask for the money, you can give it to them. But as I said, if you have too much, you then can't invest and make more money. So that's the profit problem. Regarding solvency, well, we know that banks, how do they make money? Well, we said they make loans and make investments. Okay. Now, from a profit point of view, sometimes it's worth having a bit of risk, taking a bit more risk. Why? Because of the risk return. More risk, you get a higher return. More risk, you get a higher return. However, from a safety point of view, okay, what you'll do is you'll make sure that those loans and investments are not high risk because you still get money, but you won't make as much money. So why is that a problem? Potentially a problem. Lower profits are a problem for shareholders who expect a dividend So that's how do you weigh that up? How do you weigh all that up? Okay. So on the one hand, we need to be safe, or we should be safe, but we're also answerable to our shareholders. Okay, so what's that balance? Where do we go? Do we go more safety or more on the profit side? How do we balance that up? All right. All right. Listen, guys, I've got to head off. I'm going to put these up on Collaborate in the next couple of minutes because I'm actually, hang on, let me just think. Sorry, guys. I'll put this up maybe around, so I have a meeting now. I'll put these slides up at the end of my meeting, which should be around 2:30 to 2:45, which is about an hour to an hour 10 minutes because I'm already late for this meeting. All right, so I'll be quick. So it's about answer the question directly. So this will go up on your Collaborate, okay? So you can look at it and you can email me as well if you like. Again, write clearly, precisely, and succinctly, to the point, get to the point. A lot of questions are going to ask you to do this. In your own words, explain. In your own words, explain. Okay, so it's not about memory, it's about you being able to explain. As always, you've got 24 minutes roughly. Remember, I broke it into 5 times 10. So 20, spend 3-4 minutes planning. I was already asked that. I will correct maybe close to half, maybe a bit under half. Okay, and then I moderate the other ones. Moderate means I also look at them to make sure the marking is the same, so everyone is it. Yes, I already said that. I'll be sending this. I'll be sending this PowerPoint in just over 1 hour on VU Collaborate. Okay. Oh, I will be doing that. I just said that. So okay. All right. Okay. No problem. All right. So what we've got here. So spend a few minutes. Okay. Put the main point, and remember, supporting ideas and examples. Put that down as part of your plan. And always good to start when you're answering a question. Always good to start the first part of your question going back to the question. All right, I've got to head off. What I'll do is you'll end up also getting, okay, this is very important as well. Don't write everything you know. You actually lose marks by doing, if you're writing too much that's not directly related to the topic. Your answer has to be direct to the topic, just what I mentioned before here. So please spend some time reading these notes. Answer directly. Don't write everything you know. That's not good. You will lose marks doing this. And if you write, for example, if you write cash rate goes up and you say interest rates go up, interest rates go down, if you say both, even though you're right with one of them, you get both wrong. Why? Because it shows me you don't know what you're saying. Okay? So that's what it says about this. Don't give two opposite things and you say, well, one of them's going to be right. That's okay. You get both wrong because you're showing me you don't understand. Okay? And what you'll get is, again, so you'll get an example like this, and I'll put this up. Okay, so this is an example answer. So how does income and interest rates impact money demand? Tobin and Friedman. Well, according to Tobin, income and interest rates have the following impact. So you're relating the first sentence back to there. In Friedman's theory, income and interest rates have different effects on money. You're relating it back to the question. And then you go through and give some examples. All right, apologies, guys. I said I'm meant to be 1:30 in the meeting. I'll put these slides up in just over an hour, okay, up on your Collaborate. All right, that's it. Sorry, guys, I went a bit over time, but it was a bit of a rush. So sorry about that end part. I'll see you guys. Thank you, and I won't see you again. So good luck with your exam, okay? I'll put this up just over, okay, in just over an hour. I already answered that, Albert. I said yes. I will be doing over half, or sorry, roughly half, but I will also then look at all the answers. It's called moderation, okay? So I need to moderate. So I need to look at how the other person marks, and then we send it to somebody else, to a third person. And that third person will also look at the marking. So it's going to get done by 3. Guys, I got to go. I'm getting the same question again and again. Maybe I need to type this answer, then I have to go. Okay. I will mark roughly half, then marked, but I then moderate all. Then it gets sent to a third person. Okay, and then it goes through a third person to moderate. So I mark roughly half. I then moderate all of them to make sure they're all similar in the standard. And then it goes to another one and they check that, see that we've done it well. No, there's no, okay, I got to really get help. There's no multiple choice questions. If we went back to slide 1, it's 5 short answers, 2 marks each, then 4 questions, 10 marks. Most likely, okay, will it be on lag monetary policy? Okay, you can also give me this via email as well, okay? Because I said I am really, I'm getting a phone, I'm really late now. All right. Most likely not on lag, given that we did the transmission mechanism. Yeah, so that's a bit of a hint on you. There was no cap and floor. So, guys, as I said, my word, the questions will come from those topics, okay? There'll be nothing that's not in those topics. So slide 3, okay? Go back to slide 3, look at those topics, and that will be your exam. I won't be trying to trick any of you. That's not my goal. All right, I got to head off, unfortunately. So I'll see you. Good luck for your exam, guys. All the best. All right, take care. Bye.